History is full of hedge funds that fly too close to the sun, soaring spectacularly, only to plummet all the way back down to the ground on the back, oftentimes, of poor risk management. One of the paradigm examples was long-term capital management, which was over-levered and was a catastrophic failure after having booked some incredibly strong returns. Our latest case in point, however, is Situational Awareness, an AI-focused hedge fund that did very, very well until it didn't. The Situational Awareness Fund soared to $45 billion in assets under management, a very strong return for a fund run by someone in their early 20s. The returns were extremely strong, being over 400% up until the 1st of June. However, you'll notice I say up until the 1st of June because in July, things started to turn around, and the fund was down reportedly over 60% in July, down 60% in just 1 month, with its assets under management going from some $45 billion down to about $20 billion. Still a very large number, and still the fund is up year to date, it appears. But this is a rather stark lesson. It's a stark lesson not just because of this rapid turnaround, but because oftentimes people are covering for this fund saying, well, at least it's up X% this year, as if the rapid decline was not a poor outcome. So let's dig into it, and if you've got thoughts about situational awareness, well, let me know that in the comments below. And if you want a fund that aims to get risk management under control, well, you can check out my fund, which I'll link to in the description below. We've had some really good performance, so hopefully it's going to be of interest to you. Nevertheless, let's focus on situational awareness. Basically what that fund did is it invested in AI. Its thesis was that AI was going to be the future, broadly speaking. Its plays were listed and unlisted stocks in the AI space. Now, of course, through the 13F filings, we can see what their listed positions were, but they reportedly had unlisted positions such as a stake in Anthropic, which I'm sure will have done very well and potentially could continue to do very well. Still, situational awareness was focused on that particular industry. Sometimes that can be a massive positive, sometimes a massive negative. For example, it can be a massive positive if you've got significant domain expertise in this case, in AI. For example, there's a recent paper that's forthcoming in the Review of Financial Studies that shows that such concentrated portfolios can do well if the fund manager has a strong background in that area, whether it be through their studies or through just picking up through experience. However, it can also create significant concentration risk, meaning you are significantly exposed to that one specific industry. And if that industry starts to go down, and if you haven't properly risk managed, then your fund will also go down. Furthermore, it will go down even more if your fund happens to be highly levered, which is where situational awareness appears to have become unstuck, reportedly having leverage of about 400%, which is a rather large amount of leverage. Certainly not necessarily insurmountable for short periods of time, but it is quite large, and it's a type of leverage that can backfire spectacularly if you're not really monitoring your positions or not really able to take control of situations before they start to escalate and go out of control, which is what happened with situational awareness. As some of its core positions started to decline, this magnified situational awareness's losses, much like it magnified its gains. And if you massively lever up a portfolio in a bull market, then clearly your returns are going to look good. But things start to come unstuck when the market turns around. So we can have a look at some of these large positions that situational awareness had. For example, if we go through some of their top holdings, at least as reported at the end of March, which is the latest 13F snapshot that we've got access to, well, Bloom Energy was down some 29% in the month to date, so throughout July effectively. If we have Core Scientific, it went down 12.6%. CoreWeave down 16%. Iron down 15%. And SanDisk down 40%. Now, of course, each of those individually would be bad for a portfolio, but you put all of those together being some of the core holdings, and it starts to cause the portfolio to decrease significantly, especially when you have leverage. Now, to be clear, situational awareness had some other positions as at the end of March. For example, it held some put options. However, it appears that any of those gains on those positions were not sufficient to offset the losses that they occurred on their long positions, which is why the portfolio was down over 60% in the course of July. Now, this ultimately triggered Citadel buying up their listed positions. Situational Awareness reportedly still has their unlisted positions, and I assume they're going to go back into listed positions on the backing of those unlisted ones. However, it is a clear reduction in value. Now, of course, it begs the question of what exactly can we learn from this? And as I've indicated in my fund, Otto Capital, we obviously learn from situations like this to try to avoid those types of mistakes recurring. And the biggest mistake that I see in situational awareness is simply the use of debt. They had trading on margin. They bought a lot of these stocks on margin with leverage, potentially at 400%, at least reportedly. That massively magnifies your risks, and it can result in situations like this. And investors typically are not going to stick around after a month where your portfolio has declined 60 or so percent. Furthermore, that type of leverage can cause you to have to exit a position even if you are on the right side of the long-term position. So say, for example, you correctly predicted long-term a particular AI stock is going to be particularly good. But if you get margin called and liquidated before that comes to fruition, then you will have crystallized the loss before the gain that you predicted will come to the fore. Meaning excess debt, excess leverage, excess risk can cause what might otherwise have been a good portfolio to come dramatically unstuck. Indeed, one might argue that situational awareness could have done reasonably well if it didn't take on so much risk. And the second related thing is to do with industry concentration. I already mentioned the issues with this. You just are exposed to a lot of risk if there's a particular pullback that is correlated across all of the stocks. And in AI, we've seen this. For example, we saw this recently, but we also saw it going back quite a while where DeepSeek came to the fore, and then there was a big pullback in AI stocks or AI-related stocks at that point. The issue is that if you aren't diversified, then your investors, or you need to cultivate an investor base that is willing to accept that lack of diversification and the risk that is associated with it. The third major lesson is I think it's erroneous to say a fund is up 80% year to date if it's had a massive pullback. The reason I say that's erroneous is the investors who got on at the very beginning will have still done well. They might still be up 80%. However, the investors that bought in as the fund was rising, they won't be doing so well. Some potentially could be in negative territory. That means you can't just look at things over an arbitrary time horizon and say it's perfectly okay there was a pullback. Rather, we need to look at this from the perspective of all of the investors. And we have to think about, are the investors that bought in at the top going to be particularly happy? And is the fund now going to be able to recover for those investors? Or phrased differently, everyone who invests in a fund knows there's going to be volatility. Some months will be good, some months will be bad, some months will have negative performance. The issue is, if the performance is so negative that you can't easily recover back to where you were, that's when investors start to get really annoyed and when it starts to become a problem for investors. If it's just a bad month, then that's okay, you can recover from it. And investors potentially can observe that, take it in as one piece of information, and then observe how you go in the future, knowing that there's a possibility you might be able to make it up with future performance. But when 60% is wiped off in the space of 1 month, it's going to be challenging for those investors to be back where they were. And this means the fund, in my opinion, was taking too much risk with investors' precious money. Now, clearly, if an investor invests in a fund fully aware that the risk is that high, well, obviously they've taken on the risk by investing in that vehicle. But nevertheless, it's still not good enough to just say, oh, it's up over an arbitrary time horizon, because that time horizon isn't what all investors are investing along. The next lesson is I have no doubt that Leopold Achenbrenner is a very capable individual. Probably he's quite a capable investor. He's probably going to learn significantly from this experience and recalibrate how he is going to invest going forward. However, he's in his early 20s. Now, there's nothing that stops someone in their early 20s being an incredibly gifted investor. But simply due to the fact that he is so young, he's unlikely to have invested across multiple business cycles. He's unlikely to have seen what happened in the tech wreck or the financial crisis just because he was not investing at that stage. He can learn and observe this from a distance. However, you pick up a lot more in detail when you observe it firsthand, which is why investing all in on someone so young is a significant risk. Of course, it begs the question of, does this mean that AI is going to now be a terrible investment play? Well, in my opinion, it doesn't mean that AI is over as an investment. Clearly, some of the companies since this whole debacle have actually had some decent performance, admittedly coming along after situational awareness bore a lot of these costs. So clearly AI still does have quite a lot of value to give. However, you obviously need to select stocks and select investments appropriately and manage your risk when investing in those companies. Furthermore, and slightly tangentially, it doesn't mean that AI is just going to be able to build a portfolio for you or develop an investment strategy unsupervised. Although I'm not saying that that's what happened in situational awareness's case. I've just seen a lot of people come up with AI bots that aren't necessarily that good or that effective at giving an investment that will necessarily last over the long term. In any case, I hope that gives you a bit of an idea about what happened with situational awareness. As far as I'm aware, there are no allegations of malfeasance or wrongdoing or anything along those lines. Rather, it just appears they took on too much debt and the risk management simply, in my opinion, was not as strong as it needed to be given the concentration risk in this portfolio. Still, it is a learning lesson, not just for situational awareness, not just for its investors, but for all portfolio managers, because there's a timely reminder that we need to make sure that we aren't taking on those types of risks that could backfire spectacularly. Anyway, you can let me know your thoughts about it in the comments below. And if you're interested in checking out my fund, I'll include a link to that in the description below. Like I've said, we've had some good performance, not quite as sky high as situational awareness was earlier this year, but certainly nowhere near as negative as they were in July. So our risk profile is obviously materially different from that of situational awareness. Now our strategy is derivative overlay based, and it might be of interest to you. I'll include a link in the description below, but otherwise, hopefully I see you next time as well.